Learning Objective 6-5, understand and explain additional considerations associated with consolidation. And we've talked about parent to sub, sub to parent. What if you sell from one sub to another? In other words, you have a parent and they have several subs, and one sub sells goods to the other. In that case, it's pretty much going to be the same as a scenario where you have an upstream sale. And any unrealized profit is going to be eliminated in the consolidation. The profit eliminated will be in proportion to the ownership interests of that subsidiary to the parent, because that subsidiary to the parent. Another scenario would be lower of cost to market. You would always write down to lower of cost to market. So if inventory is purchased and written down, then that would be a loss on which might be included in cost of goods sold. If it's relatively routine. If it's not routine, it would be included in a full loss. So let's look at an example on this. Suppose a parent company purchases inventory for $20,000, sells it to the sub for $35,000. The sub holds the inventory year end, and then it determines that it's overvalued, and the market value is $25,000. Then the sub would write the inventory down to $25,000 and would have a loss. And this would be the journal entry on the books of the sub. What this would mean is that this would mess up your elimination entry, and then you should go to whoever did this and you'd hit him on the head or something. Debit sales for $35,000. You'd credit the cost of goods sold that was originally recorded for $20,000 in your elimination entry. And you would write down the inventory by only $5,000 because the other $10,000 it's already been written down, and then you'd record a loss on decline in inventory value of $10,000. What do you do if you have intercompany transactions before the affiliation occurred? So if you were anticipating a merger and it wasn't really an arm's length transaction, in other words, the price was set knowing that you would be one organization, then the sale would need to be eliminated. But if you had two separate companies that didn't know they were coming together and that had an honest transaction between them, then you may actually have a sale. But any transaction where it would be suspect that the transaction was motivated by was really a transfer price, then that would need to be eliminated. In general, we would assume that transactions before the merger are separate and independent, and transactions after the merger or acquisition would need to be eliminated. And the real test here was whether or not there was an arm's length bargaining. If it was an arm's length bargaining, then you can record it as a real sale, as if they were two separate parties, and no consolidation is no elimination is necessary. But if the transaction occurred knowing that these are two parts of the same company, and sort of instead of having a negotiation, you had a decision that was made together, then that would need to be eliminated.